intraday chart of that particular name as well. Rahul Singh, CIO at Equities at Tata Asset Management, joins us on the show. Hi, Rahul. Good afternoon. Good to see you win. Well, what are you making of our current market setup? You're at around 21,700. Things were eye-poppingly much more attractive, and that's why we did see that a lot of interest came back in, and the markets have bounced close to around 15%. But earnings have still been rather subdued, maybe on expected lines, expected to pick up from year on, though flows have been quite good. Both domestic flows and the FIs are making their way back. How are you feeling about the Indian markets as of now?
Yes, I think the markets or the valuations are at an interesting point because from here on, the earnings outlook for next year becomes important. Obviously, the global liquidity environment has turned positive for emerging markets, including India. So that's a good news, and that kind of puts some kind of a floor to valuations in my mind. But whether we give what kind of returns we can give from here is going to be totally dependent on the earnings outlook for the next financial year, because we've not had a great performance from earnings in fiscal 25. But the good news is that all the things which were going wrong in fiscal 25 in terms of liquidity, in terms of the government spending, I think, are normalizing very, very fast this year. So I remain more optimistic about this year's earnings growth rate for Nifty, more in maybe around the low teens number, is looking like a possibility, which is compared to last year's weaker base. I think consumption is also being pushed a lot through both monetary and fiscal policy. So there are building blocks for earnings to look better, not supremely better than last year, but significantly, materially, I would say, different from how last year panned out. So to that extent, I think markets are looking reasonably stable with with not too much of downside risk at this point of time, in my view.
All right, that's good to know, Rahul. Great to have you on the show this afternoon. Thanks for joining in. So there's not much downside risk. Then let me flip that question then. Then what's the best upside play? I mean, having gone through the earnings season, looking at the second half of the year perhaps, where do you see the maximum prospects for growth? Which segments or sectors?
Well, definitely, I think large caps are looking much better from a risk-reward point of view. I think that's where the downside risk is the minimum. It's probably much higher in mid caps, the downside risk from a valuation point of view. So I would like to make that distinction very, very clearly when I said that about the downside risk. And also from a segmental point of view, from a sectoral point of view, I think we have been saying about BFSI, but things are finally playing out. And if you look at the performance of banking as well as the insurance sectors, they've been one of the more solid performers in this volatility of the last 3 to 4 months. I think there's been more steady performance from BFSI, and I think it's just the beginning. We're probably going to see next 1 or 2 years of this whole performance percolating down to different categories of BFSI as we speak. Also, I think selectively, given the push both on the fiscal and the monetary side, consumption is something where we need to watch out for in terms of early signs of revival. And I'm talking of the whole spectrum of consumption, not just FMCG. So these are the two kind of buckets I would focus on.
Okay, all right. What about some domestic-facing themes, Rahul? Something that will be reasonably protected from what's going on in the globe. Case in point being cement or maybe real estate. From the domestic-facing themes, what do you like?
Yes, those are two sectors which definitely come to mind, clearly from a domestic point of view, or even though banks are also mostly domestic plays. So to that extent, it kind of qualifies for domestic play also. But cement, yes, I think it's been a sector which is promised so far and not delivered on earnings. So to some extent, I think if the pricing discipline comes back and the prices are under control, the input prices are under control thanks to lower commodity prices, this could be the year when earnings finally start to deliver for cement. As far as real estate is concerned, I think we are well and truly into the mid to late cycle of the growth. So from here on, I think we are very, very selective on real estate, even though the demand momentum continues for real estate across the various markets. The valuations and the risk profile of each real estate company is now very different compared to at the beginning of the cycle. At the beginning of the cycle, everyone benefits, but at the mid to late end of the cycle, you need to become more cautious given the profile or given the mix of the geographies and given what's happened in each of those micro markets or geographies.
Rahul, on the financial space, what part of it do you specifically like more? I mean, is it large banks, private PSU? Is it non-banking lenders? Or, I mean, then there's the other related parts as well, right? There's wealth management, capital marketplace, brokers, etc. So it's a very vast spectrum. What is your order of preference here?
Yes, you're right. There is a vast spectrum, and that's the good news because the whole, the whole valuation and the growth outlook kind of changing has to percolate down to the last possible segment of the lenders at least. And that's where I think the opportunities and the excitement is. And obviously, large private sector banks are now a consensus view, so I'm not going to, repeat that. But I think there is also opportunity in the NBFCs because they will start benefiting from the lower rates sometime in the second half. There is also, I think, from an NPL perspective, there has been a lot of tightening of controls by the regulator, which is resulting in, I would say, not very volatile NPL as we used to see earlier. So that's also something which is positive for NBFCs. And the other segment, which is time corrected for a significant amount of time, is the housing finance companies, the small and mid-sized housing finance companies. So these are some of the segments which we are focused on.
Okay, all right, Rahul, the renewable sector theme that was in flavor, just not too long ago, 18 months or so ago. But that seems to have been put on the back burner. So some of these companies are guiding still for very, very good times ahead. Is that a sector you're interested in, or do you think the good times have passed? There's too much of uncertainty. You'd rather stay away?
So renewables went through a euphoric period, you're right, and I think the valuations crossed certain limits. So, it's a cycle. I think the build cycle for renewables is probably going to peak out in the next 2 to 3 years. So you have good earnings momentum, but you don't have sustainability of those earnings for some of those equipment suppliers. So one will have to be extremely careful about when these companies peak out in terms of valuations if they have not already. Because ultimately some of the barriers to entry which were there earlier may or may not sustain. So to have lofty valuations with these kind of business models is a challenge. As far as the utilities are concerned, on the renewable side, there are a few pure plays, but what we like in the power space is the utilities, whether it's the fossil fuel or the renewable energy. I think that is where the valuations are reasonable after correction. And I would, we are more focused on that segment as compared to the equipment manufacturers in the renewable space.
Rahul, hi, afternoon. This is Rima here. On IT, where do you stand? Numbers have been disappointing. FY26 is going to be a challenging year. But on the other hand, there is that argument that these are dividend-paying companies. And now, with the correction, the dividend yield is fairly attractive. So yes, it's going to be a low growth year for the companies, but the downside may be protected. Considering the volatility, would you look at IT stocks?
Yes, I think you summarized it very well, that it's become a range-bound sector. I don't see a lift in revenue profile for the sector as a whole from mid-single digits to 15%. Unless that happens, it's very difficult to go overweight on this sector. Today, the downside risk and the upside risks are kind of balanced because, as you mentioned, on the downside, at 10-15% lower levels, the dividend and the free cash flow yield starts to provide a flow to the valuations. But on the upside, we need to see reasons, or we need to see the logic for growth to revive for the sector as a whole to mid-teens for us to start looking at a valuation re-rating. Otherwise, it's going to be a little bit of a range-bound sector for now.
Okay, all right, got that point. Thanks very much, Rahul, for joining us today. Good to get that perspective from you on the market and all the themes and sectors that we've discussed. Thanks for joining in.